relevant investment strategies in this time of stock market uncertainty. Okay, so first of all, I want to thank the Morrill Memorial Library for the opportunity to present this evening. I represent SOFA. Hold on, somebody wants to come in. Okay, I represent SOFA, the Society for Financial Awareness. This is a nationwide nonprofit organization whose mission it is to provide financial education in communities nationwide. For more information on this group, you can go to sofausa.org. Okay, and all right, so just a little bit about me. I am the director of SOFA for both Providence and Boston chapter. I've got a lot of years in financial services. I won't go into all the details there, and I'm also the author of the book 6 Steps to Retirement. And I'm going to actually later on give anybody that wants an opportunity to get a complimentary copy of the book. Let's see, also, if you have something to write with and take notes on, that's recommended. There may be some things you want to jot down as we go through. And just a very quick disclosure I have to read to you. This presentation is for general information purposes only. It's not intended to provide tax, investment, legal, or insurance advice. It's recommended that if you need this type of advice, you need to seek a professional in one of these disciplines before adopting or implementing any of the information that we're talking about here, or frankly, information you gain otherwise. Okay, let's see. So what does this number represent? I'll just give you a quick second to look at that number and think about it. All right, that's it. Time's up. This is what the Dow Jones Industrial Average was on February 12th, 2020, this year, obviously, represented the high point for the Dow Jones, which was obviously a very happy day for a number of people. Let me give you the next number. Okay, so look at this number. Obviously, you're going to be able to guess that this is also another Dow Jones number. This one was on March 22nd, a little over a month later, and obviously considerably lower, about 30% lower. I haven't done the math on that, but that's roughly what it is, or was. Obviously kind of a sad day for many of us at that point. Okay. So, based on that occurrence earlier this year, should we even be talking about investing? Well, okay. In the midst of all this, we're dealing with the coronavirus. You know, our lives have been on hold to a large extent. The unemployment rate is now at levels we haven't seen since the Great Depression. A lot of stock market volatility, a lot of volatility in general. So why are we even talking about investing? All right. Well, let's take a stab at that. Let's take a stab at answering that question. Why are we even here talking about this? All right, so just very quickly, here's an agenda for tonight's meeting. We'll talk a little bit about some history, which I think is relevant, factors that impact the economy and stock markets, components of an investment strategy, and finally, we'll talk about some actions that I suggest you consider taking. Okay. And again, I'm going to give people an opportunity to get a copy of my book. I'll talk about that later on. Okay. How does this particular stock market crisis, and we'll kind of characterize it as a crisis, at least for the moment, although it has recovered, so perhaps we're not in a crisis anymore, but we'll talk more about that. But how does this compare to other stock markets, other economic circumstances of the past? So just to kind of give you a quick list here, these are some terms I'm sure you will recognize regarding previous economic conditions and circumstances. And we'll go through all of these relative to your let's just say, investing interests and what you might decide to do going forward. So let's just look at what's happened over, say, the last 50 years with a variety of different stock markets. 1973, 74, the oil embargo and Watergate, which caused the markets to lose almost half the value. Black Monday, I remember this day, very vividly. I was at an office. I was actually right out of college, one of my first jobs, and Market, worst day ever, lost almost a quarter of its value. We obviously remember the dot-com bubble and followed by the September 11th tragedy, lost 49% in the markets. The Great Recession, more than half of the stock market value was lost. More recently, December of 2018, the China-US trade war rattled the market, lost about 20%. And then what's happened earlier this year. So just a quick historical description of some of the stock markets, which I'm sure you will recall. Okay, so looking back at history, however, it would seem that the markets do generally recover. So if we go way back in history, way back to the late 1800s, and we kind of follow it forward, we see lots of peaks and valleys along the way. Here's the Great Depression. There was a peak and then a big valley. But again, you kind of see, the ups and downs of the market. But overall, the point here is that the market has trended up over time. So again, the resiliency of the markets. But does that mean in this particular case that we're out of the woods? Well, there are factors that we need to understand here. For example, the unemployment rate, corporate profits, and what's going on with businesses in general, stock market volatility, and finally, consumer confidence. So we're going to touch on each of those. First of all, unemployment. Now, unemployment was doing just fine. These are new claims and continuing claims right up until mid-March, and then obviously we see what happened. A big spike in new claims. Now, new claims has dropped since then, but continuing claims have remained higher. So bottom line here is that we have not seen unemployment rates like this since the Great Depression. Then there's the corporate profits, or basically what's going on with businesses in general. A large percentage of CFOs are expecting, and this is obviously very clear to everybody, I think, that there is going to be cuts in corporate profits. There's going to be losses. So this is going to be a huge problem for profits of large and small companies going forward for who knows how long. Again, healthcare organizations, major companies are expecting that this is going to be a lasting event. Here are some headlines from Yahoo Finance, Business Insider, Bloomberg, basically that businesses are facing bankruptcies at unprecedented levels. Again, businesses are dying by the thousands, and frankly, the carnage, as indicated here by Bloomberg, has not even been calculated yet. And then there's basic stock market volatility. Now, we're looking here. This is what is showing as of the middle of February, and this was new highs, as we discussed earlier. The stock market over the previous year, the S&P 500 was up about 13%, the Dow up 8%, the NASDAQ up almost 20%. Then a month later, losses. 25% down, 30% down, 16 and change down, and then a recovery. And again, the recovery is good, but what this really points to is this aspect of volatility. So what drives that is in large part fear. Now, there's an index which you may or may not have heard of called the VIX index, which is a measurement of exactly that. What is the sentiment of the market? Because sentiment, emotion, is a big factor in driving markets up and down. You like to think fundamentals is king, but in large part it's fear. So you look here, and at the beginning part of 2018, the fear index, the VIX index, was up. There was a drop in the market. Over here, 2019, or the end of 2018, again, high in the fear index, a drop in the market. And again, right here, we're seeing, there's a lot of concern. And again, we experienced a big drop in the market. So it's important to understand how that plays into it. And then gross domestic product. So this is a measurement of what the economy produces in terms of goods and services, and for a stretch of time, a long period of time, it was doing pretty well, between 2 and 4%, which is about normal and acceptable. But then this year, a big drop in the first quarter and a record-setting drop, more than 30% in the second quarter. Now, why this is important relative to investing, and again, the whole point here is, how do you go ahead and develop an investment strategy? What do you do with your investments going forward? Consumer spending accounts for 2/3 of GDP. So the economy is not going to get going again until the consumer is feeling good, is feeling better, and ready to spend money again. So this is obviously a big measurement, an important measurement of what's going to happen going forward. And then I'd be remiss if I didn't talk about the Federal Reserve, the influence of the Federal Reserve. And this is actually something that bears watching more than some of the other factors going forward. If we look at what happened in 2008, and the reason that we recovered from that was because the government, by way of stimulus packages, or quantitative easing as it was termed, more technically quantitative easing, or QE1, and then QE2, which occurred starting 2009 into 2010. Then there was a third round. And what this did was this helped the economy recover by providing liquidity to the financial markets. It allowed the real estate market to recover, interest rates to remain lower, and the stock market to recover as well. Actually, right here, beginning in 2018, they were actually reducing the size of the Fed balance sheet. But unfortunately, because of what's happened with COVID, we're now seeing that a pronounced upswing in the Federal Reserve in their providing liquidity to the markets, basically called QE4. So it's important to understand that the Federal Reserve is really primarily responsible for the recovery of the stock market during this particular cycle. It's not because of fundamentals, unfortunately. It's because of the influence of the Federal Reserve, and that's likely to play into the markets going forward. Then we think about the type of recovery that we would have, and again, there's the V-shaped recovery, which is very simply a drop in economic activity with a quick bounce back, and you're right back on track. The U-shaped recovery, which is, again, a drop in economic activity, takes a little bit longer to recover, but gets back on track. And again, there's other shapes that we can discuss, but the one that I think bears watching is, will this be an L-shaped recovery? Which means that you have a drop in economic activity, GDP, for example, but it does not bounce back, or it takes such a long time to bounce back that it does still take the shape of an L, the letter L. Okay. So going back to what the title of this this presentation is, investment strategies in this time of stock market uncertainty. What we really want to better understand is, obviously, how do we do this? How do you develop a strategy? How do you maintain a strategy you might already have? Given the insecurities that we're all feeling, the volatility in the financial markets, and frankly, the political and social divisiveness which is going along with all of this at the present time. So, I'm going to ask a question relative to that. How do you develop a strategy? Well, we need to understand what makes a good investor. What characteristics are inherent in a good investor. So obviously you all recognize the gentleman on the left here, Warren Buffett. He is a very astute investor. He knows, he's the Oracle. He's the Oracle of Omaha, and he has done tremendously well as an investor. Obviously, we all understand that. So obviously we'd all love to be like him. How does he do it? How does he manage his investments, and how does he build wealth, or how did he build wealth? Then there's the gentleman on the right. Is a good investor somebody who simply has tons of research, is doing it, 24/7, has all kinds of information at hand? So what is a good investor? That's what we're going to get into. So let's talk about investing. Okay. So when is the best time to invest? So just think about that for a moment. And again, don't overthink it. The answer to that question is yesterday. The best time to invest is yesterday. When is the second best time to invest? Again, don't overthink it. It's today. The point here is that you should be investing. If history teaches us anything, you should constantly and consistently be investing money. And we'll talk more about, why, when, and where, and all of those things right there. So here's a critical investing concept. Time in the market versus timing the market. Let me say that one more time. Time in the market versus timing the market. So time in the market refers to the strategy of buying and then holding investments regardless of market conditions, economic trends. You simply buy and stay in the market. Timing the market is about trying to time investment decisions based on when you think the markets are up and when you think the markets are down. So passive, the first one, time in the market, is really talking about passive investing. The second one is talking about active investing. So which timing strategy is best? Well, there's this organization called Dalbar. Actually, I reference them quite a bit for information that I need to obtain. But this is a company that studies investor behavior and analyzes market returns. And what they show is that consistently, the average investor earns below average or below the average market returns. So, for example, for the 20 years ending 2015, the S&P 500 averaged a return of almost 10%. Great. I mean, awesome returns over that long stretch of time. However, the average equity investor only earned about half of that. The reason for that is that investors tend to manage their investments using emotion. They tend to be illogical in how they approach their investing process. And this tends to lead to poor decision making that affects long-term investment returns. For example, there are numerous studies showing that when the market rises and hits new highs, people tend to say, okay, great, the market's good, I'm going to jump in. And then when the market is down, when it corrects, people tend to sell. So again, they're reacting to what's going on instead of developing a strategy and being more proactive. So if you look at, again, going back into history, history is a great teacher, obviously, and you look at the active managers versus sort of just passive, just the buy and hold strategy, you go way back into the mid-'80s, and you'll see that there was sort of, there were really not a significant difference between passive and active returns. But then when you get into the early 90s, if you recall, that was the time when the S&L banking crisis hit, and that obviously caused some problems in the markets. That's where active management actually produced better returns compared to passive management. Then we get into the mid-90s, and this is where the markets took off. If you remember, this is the dot-coms. A lot of the dot-coms helped. They contributed to the investing return, especially in the passive area. And that was a time period where passive investing did better than the active management. And then between 2000 2010, active management did better than passive, and then again we had a reversal. So it's not that one is necessarily better than the other. It's really just looking at market conditions and timing. So again, active versus passive. Not one is not better than the other, but it's important to understand the distinction between the two. But what I have found over the years is that investors tend to make less than ideal decisions because they lack a clear strategy. A clear and well-conceived investment strategy will work during really any market conditions. But there needs to be at least three things considered. The first is, why are you investing? The second is, where are you investing? Where are you putting your money? And third is timing, when to invest. So let's look at each one of these. First of all, the why. Why are you investing? What are you trying to achieve? What are you saving for? For example, buying a home, lifestyle choices and activities. Do you have kids? Are you saving for college? Retirement, obviously, that's probably the biggest reason people are saving and investing. In other words, what is your why? What are you trying to achieve? You look at what your investment goals are, the amount of money that you want to accumulate, the time frames between when you start to save and when you actually need to have that money. And then as you are saving money, as you are implementing and managing your strategy, you have to include ongoing reviews to track progress. Know what you want and have a plan to get it, have a strategy in place. There's two primary whys with regard to this. In other words, why are you investing money? Are you investing to grow your money, to accumulate, or are you investing to produce income? So for example, if you're a younger person, you might be more oriented towards growth. If you're older, approaching retirement, you may start to think, rather than accumulating, I really need to be investing my money to produce income. So if you're looking to grow your money, then you might be looking towards smaller companies, or mid-sized companies. Emerging markets is another area where you can find opportunities to grow your money more aggressively. These tend to be younger companies. They tend to be reinvesting their profits to continue to grow rather than paying out their profits. They tend to offer higher returns in good markets, but there's also more risk. In other words, in a bad market, or if a particular company runs into trouble, then there's a lot more potential for loss as opposed to growth. So again, more volatility with this type of a strategy. And again, this isn't just in general terms, because you can have conservative growth strategies, you can have aggressive growth strategies, but again, it's that aspect of investing for accumulation. Then if you're investing for income, then you're probably looking for companies that are more mature. They're larger companies. They've had their opportunity to grow already. They are generally paying out profits in the form of dividends. Another area to invest for income is obviously bonds or fixed income, where you receive interest. And then there's cash equivalent, bank instruments, where again you receive some interest, although bonds and cash equivalents are generally not paying that high in terms of returns at the moment. We'll see how that trends. Real estate is another opportunity, as well as annuities and life insurance in terms of producing income. Again, it's all about accumulation and distribution. Accumulating to achieve an amount of money for some stated objective, and then distribution in order to produce a certain amount of income. Oftentimes, that's something that people plan for retirement. Okay, and so let's talk about the where. So where should you be investing? Well, obviously the stock market, bank products, life insurance, annuities, real estate, bonds, commodities, and collectibles. There's all kinds of opportunities within all of these categories for investing. If you're investing for retirement, you're obviously going to be looking more towards some of these tax deferred or tax preferential instruments. If you're saving for college, 529s and life insurance are good areas. But ultimately, what you want to do is to be well diversified among asset classes and holdings. So when it comes to the where, you're looking at being properly diversified. And it's also important from a diversification point of view to understand the term asset allocation. So this is a strategy for creating a personalized portfolio by investing in stocks, bonds, and certain cash equivalents, and then investing in various proportions. For example, if you're investing to be more conservative, you're likely to have a higher percentage of bonds and a lower percentage of securities. If you're more aggressive, you're going to have a higher percentage of securities, lower bond percentages. And there's also this style and what we call, well, the style and class of investments and the weighting that you have within each of those. So just to introduce the style box, which you might be familiar with, Morningstar uses these. And it's really just an understanding of, if you have securities, what type of risk you would be taking. So for example, the larger the company, the lower the risk. If it's a more of a value-based company, companies that tend to be older, dividend-paying companies, often companies that have value in terms of the opportunity to perhaps grow, compared to smaller companies or companies that are more in a growth mode, and then the blend between the two. So what you're looking at here is higher risk as you gravitate towards smaller companies that are oriented towards growth, or larger companies that are basing their strategy on paying out dividends, for example, and maintaining, not necessarily growing. Then there's the dividend style, the bond style box, which again is something to look at when you're investing in bonds, where you look at credit quality. For example, a government bond, a U.S. Government bond would be considered a higher quality investment, whereas different types of bonds, there's a whole variety of them, may be lower quality. For example, high yield bonds, which used to be called junk bonds, are obviously going to be lower in quality. And then you have the short term versus the longer term durations. So again, higher risk with the longer term durations and the lower quality versus short term and high quality bonds. So be familiar with the style box. Now let's talk about the when. So the when is how much to be investing and the frequency of adding to your investments. For example, affordability. What you want to be doing is trying to save at least 5 to 15% of your gross pay, or whatever you can afford. So affordability is important so that you can continue to invest on a consistent basis. Then there's how much you should be putting in incrementally to achieve particular objectives. For example, if you're saving for college, what is the projected future cost of college? How much would you need to be saving in order to accumulate enough money for public, private college? I know I've had 3 children go all the way through college, and I remember when my wife and I were saving, we were always utilizing a variety of calculations in order to determine how much we needed to save in the 529 plans that we had. So again, it's understanding what your goal is, the time that you have to save for that particular goal, the anticipated rate of return. In other words, once you invest that money, what do you anticipate the rate of return will be? And again, that's just going to be something you might estimate anywhere from maybe 3 to 6% to be conservative. And then incrementally saving that money. And even if you can't save what you quote unquote should be in order to achieve the goal, at least save something, because you can always increase later what you're saving. So if you start off low, you can always increase it later and make up for it. Then there's compounding. Now this would be compound interest. Also there's the aspect, if you're collecting dividends, of reinvesting the dividends and having the dividends compound. So earning interest on top of interest, or gains on top of gains. So this graph right here shows what the amount of money that you would accumulate by reinvesting interest or reinvesting dividends compared to just simple interest, where you would be just taking the money out and perhaps just leaving the principal in there. So compounding is a very important concept when it comes to accumulation, growing your money over time. Now, it's interesting that Albert Einstein characterized compound interest as the most powerful force in the universe. We obviously all know who Albert Einstein was, and he obviously dealt with very powerful concepts. So for him to characterize compound interest in such a way, I think is noteworthy. Okay, then there's dollar cost averaging. Again, there's that aspect of, should I be investing now while the market maybe is volatile, maybe the market's down, or the market's going up? Do I want to wait until it goes down again? And in other words, there's that aspect of trying to figure things out or time things, as opposed to simply just investing on a regular basis, regardless of what's happening, to allow for an overall average, an average that you receive for just investing consistently. So you'll see here, this grid right here just shows you're investing. Each of these red points is when you invest, and then there's the ups and downs of the market. Sometimes you're investing when the market's up, sometimes you're investing when the market's down, but your overall average is along this line right here. And if you invest consistently, then you'll have long-term consistent growth. So it's better in this vein to simply continue to put money into the market and not try to second guess the market. Other investing considerations include risk. So in other words, what is your risk tolerance? Now, one of the things I do when I'm working with clients, especially when they're new clients, is to help them to better understand their level of risk tolerance. In other words, are they more conservative? Are they willing to take more risk? A lot of times that has to do with what their objectives are, perhaps what stage of life they're in. But it's very important to assess that. So what is your risk level? What kind of investment strategy are you going to deploy based on that particular risk tolerance that you've calculated? Taxation. You have to pay taxes, obviously. The question is, when will you pay them? One of the things that you have right now with programs like 401ks, 403bs, IRAs, etc., is that you're given a choice as to when you want to pay taxes. Obviously, you can defer taxes to the future, or you can pay them now, say in the case of a Roth IRA, and then you can receive tax-free gains for forever. So taxation is an important consideration when you are structuring your investment strategy. Liquidity. Obviously, if you need funds for specific purposes, for example, if you're looking to buy a house, if you're a young person, you want to buy a home, then you're not going to invest that money in something like an IRA or a 401k. You'll have to look for other investment vehicles that allow you to have liquidity so that you can utilize that money, because obviously age restrictions, surrender charges have to be taken into consideration when developing your investment strategy. Inflation. Now, inflation is going to diminish the purchasing power of money over time. Now, inflation is very low right now, stated inflation anywhere between 2.5%, 3%, although real inflation is probably a little bit higher than that. But if you use, say, 3% as your inflation average, then over a 10-year period, you're going to lose 30% of your purchasing power. Oftentimes, an investment strategy will be structured simply to realize returns that are sufficient to offset the impact of inflation. So this real rate of return number, if you have a 3% inflation factor and you get a 3% gain, then essentially you have broken even. So you've simply maintained the purchasing power of your money. So inflation must be factored into when you calculate rates of return versus real rates of return. And then fees. Now there's expense ratios, investment management fees, loads, transaction fees, etc. Now fees by themselves are not a problem. You're going to pay fees regardless because the investment industry is obviously a profit-making industry, so they're going to be charging fees. The question is, are you getting value in return for what you're paying? Quality investment advice, etc. So you just want to make sure that you know what you're paying and what you're getting in return for what you're paying. And then legacy. Now, legacy is important because if you're investing, some people are investing simply for their own needs. They're not concerned about leaving a financial legacy. Other people that I work with are very concerned about they want to leave money for family, charities, organizations. So if that's one of your stated goals, then that has to be included in your investment as you develop your investment strategy. All right, so we have obviously a very short time on this call with this presentation to really develop, for me to really educate, provide information on investments and investing. There are a lot of other terms which you will run across, some of which you've probably run across that you see here. Some, again, you might recognize these, you might know what these are, or some of these things you want more information about. Again, investing, this is really just an overview type of presentation. Jot some of these down if you want additional information on what these are. Some of these things can be very important in terms of understanding your own investment strategy and just having a comfort level with what you're doing with your investments. So I wanted to just display some of these terms. If you have any questions on them, I'm obviously available outside of this presentation to assist you with additional information and questions. And I'll give you more information about that. Okay, so let's get back to that question I asked earlier. What makes a good investor? Again, we'd all like to be, like Mr. Buffett. We'd all like to, have all of his billions and his insights into investing. Or maybe we're inclined to be like the gentleman on the right, and do some day trading and sit and stare at screens all day, whatever. But to be a good investor, you need some basic things. First of all, you have to set goals. Understand your why. What are you saving for? What are you investing for? Knowledge is very important here. Know what you're investing in. Now, this is a huge challenge. All three of my kids all have investment accounts, and I have been trying to teach them how to identify opportunities and better understand them. One of the things that Mr. Buffett always talked about was that he did not want to and never did, not I would say never, but he claimed that he did not invest in things that he did not understand. Actually, that's one of the reasons that he did not get caught in the dot-com bubble when that burst, because he said, I didn't understand a lot of those companies. They didn't make sense to me. They weren't producing anything. They weren't making a profit. So he just only invests in things that he understands, and it's obviously served him very well. So again, understand, what you're investing in, do the research, gain the knowledge. Patience is very important. Have a long-term perspective on your, within your strategy. Don't make emotional decisions. Again, things happen along the way. I know this past February, a lot of the people that I manage money for, I had conversations with pretty much everybody. And fortunately, very few, there were a couple, but very few people divested. Most people just hung in there and, just wrote it out, and they're happy they did that. So again, have a long-term perspective. Understand your risk tolerance. There are some people that are just not suited for investing or certain types of investing because it simply keeps them up at night. If something's going to keep you up at night, then you shouldn't be doing it. Understand your risk profile. And strategy, and again, I just said this, stick to your plan, don't make emotional decisions. All right, so what's next? So these are the 3 action items that I recommend and that I help my clients conduct and work through. The first one is balance sheet. Now I'll go through each one of these. First one is balance sheet. Second is budget, and third is breakdown of investments. So let me touch on each one of these. First of all, a balance sheet. It's very important to know what you have. In other words, take an inventory of all of your assets and all of your debts, all your retirement accounts, various investments, banks, bonds, annuities, life insurance, everything that you have, and then also all of your debts, credit card, mortgages, auto student loan debt, and make sure that you understand what the net worth is. Now, net worth is a very important number because it's essentially the sum total of all of your financial decisions. It represents what you have accumulated and obviously compared to debt, and your ability to know what that number is and then track it over time will help you to measure how effectively you're managing your money. Net worth is a measuring stick of how effectively you're managing your money and how it's being managed for you if you're using an outside advisor. Know what you have, know where it is, and know what it's all worth. Now, I have tools that I provide that automate this for people using various software packages. I also have, hard copy forms to help people to develop their balance sheet. So again, make sure that you have a functioning balance sheet. Then there's step 2, which is budgeting. This step is about knowing really how much you're spending, knowing where you're spending it and how much you're spending in different categories. Everything from housing costs, the groceries, transportation, healthcare, and then discretionary items, knowing how much you have coming in income, and then knowing specifically how much is going out. This will help you to establish a spending plan that will not only cover the expenses that you have, but then help you to have funds left over for saving and for investing. This is an area where you want to be very proactive. Too many people are reactive to their money, reactive to their spending. In other words, the paycheck comes in, they pay whatever bills have to be paid, and then if there's anything left, hopefully they're able to save some money. But it's that aspect of pay yourself first, and then take care of your bills. Save your 5 to 15%. And be proactive in how you do that. And I have, again, a variety of tools, both hard copy in terms of developing, a budget, and then also using various types of software to automate it so that you can track it more easily. There's a lot of great tools that are available today to help with not only budgeting, but also balance sheet maintenance. Then there's step 3. Now, this is the breakdown of your investments. So this is about analyzing, for example, the performance of your investments against relevant benchmarks. How are your investments performing against, say, the S&P 500 or the Dow or the Russell? There's a number of different indexes that you can utilize to assess how effectively your investments are performing. Are they performing according to your expectations? And how do they measure against benchmarks? Know what fees you are paying and again, we talked about this, what value you are receiving in return for what you're paying. The taxation of your investments. Taxes, this is an area of planning. I'm a chartered tax advisor. I've done tax prep work. I do a lot of tax planning for my clients. This is an area which is going to become more and more important as time goes. I won't get into it right now, but taxation of your investments is a very, very important part of your strategy. And then also understand how your investments are allocated, especially relative to stock market risk. We talked a little bit about that earlier. What is the allocation? More conservative, more moderate, more aggressive? And does that match your risk tolerance? And again, I have tools that help to break down performance, understanding what you're paying in fees, how your particular allocation has performed at various other times during other difficult economic and stock market points in history. Again, what's your allocation relative to the mix between bonds and securities, and within those groups, do you have more large cap, more small cap, more high quality bonds, lower quality bonds? In other words, understanding exactly how your investments are allocated. And again, just each security, how they have performed, say, over the past year, the past 5 years, the past 10 years, since inception. Also, what type of yield are you receiving from your various, your various investments? How much are they throwing off, say, in terms of dividends? Okay, so this presentation has really been, we've touched on a number of important topics. Hopefully you've had a chance to take a few notes on some things that are of more interest to you. But we've really only scratched the surface. There's obviously a lot more below the surface. So I certainly am available by way of, you can call me. That's one of my numbers. I'm, here in Easton, 238-9000. Call if I don't answer, leave a message. I always call back. There's also, okay, so when you started this presentation, or when I started this presentation, you had some questions. Hopefully at this point you've gotten a few of those questions answered, or maybe you have some ideas in terms of more information that you need to gather. So one of the things that I want to do is give you an opportunity to get a copy of my book, 6 Steps to Retirement, which incorporates a number of the things that we've talked about tonight. Very simply, just go to this website, 6stepsbook.com, and you'll see where you fill in your name and address, and I will mail you a complimentary copy of my book. I also am happy to give you a complimentary subscription to my weekly email newsletter. It's called the Weekly Economic Update, along with a few other communications I send out. But what this does is it gives you a weekly update on what's going on Wall Street and what's going on in the economy. So again, this is complimentary. It's a quick read and some good information. Just send me an email to sofawalpolema@gmail, and I'll be happy to add you to my mailing list or my emailing list. And if you'd like to schedule a meeting with me, right now I'm doing a lot of virtual meetings using Zoom. So just go to this website, meetingmike.com. It'll bring you right to my calendar, and we can schedule in a call or presentation, usually half an hour or so, or even longer if there's additional information you need, but feel free to do that. I offer these on a complimentary basis. Okay, so the purpose of this presentation was really to help give you a better perspective on investing. Looking at some historical information, looking at some basics about investing. History does suggest that markets are very resilient and have bounced back in the past from crashes / corrections. That's not necessarily predicting that that things are going to be bouncing back right away this time. Of course, the stock market has bounced back fairly nicely, although I have some ideas and some concerns about that, which we can certainly discuss offline. But by being proactive and taking some of the actions that I suggest here, you will put yourself in a much better position to assess your options and identify your opportunities. Your goal must be really to develop a goal-oriented investment strategy that has you consistently contributing to your investments over the long haul, have a long-term perspective. You can invest successfully no matter what is going on in the economy or in the stock markets. You simply have to have a clear strategy that you can follow, that makes sense, that's goal-oriented and is affordable, so that you can continue to put money in consistently. Dollar cost average money in, let it grow over time. Again, it's not a matter of trying to time the market necessarily. There's an aspect of that which can be utilized, but it's really having that basic strategy that is consistent with a long-term perspective, consistent contributions with a long-term perspective.